All right, we're looking at several big stock market stories right off the top. Shares of tech giant Cisco plunging in after-hours trading. Although they reported better than expected earnings, CEO John Chambers laid out a very cautious outlook. Plus, the Fed announced today that its first QE2 bond purchases will begin Friday. On the other hand, long-term interest rates are actually edging higher, not lower. Plunging jobless claims this morning suggest that the economy and employment may be picking up steam. And in just a few moments, we're going to get a special report on President Obama's deficit commission, allegedly to solve America's bankruptcy. All right, joining me now to talk about all this and more, CNBC contributor Don Luskin of Trend Macro, Barry Ritholtz from Fusion IQ and the brains behind the terrific Big Picture blog, and Lee Munson of Portfolio Asset Management. Welcome, gentlemen. Barry Ritholtz, can you give me a quick take on the Cisco? The revenue's really disappointed, and as far as I understand it, disappointing tech spending by consumers. Local governments are disappointing, and cable TV is disappointing. How do you read it?
Well, the government spending is not a surprise. Most of these local municipalities and states are fairly broke. I was surprised to read what they said about consumers, because between the Androids and the iPads and the iPhones, the consumers have shown a willingness to spend on gadgets and services if they think it's worthwhile. I also was surprised about what they were saying about the outlook for corporate spending. Everything we've been hearing has been a gradual ramp up of corporate spending. We're sitting on $2 trillion in corporate money. You know they're going to have to spend it. The whole idea behind QE2 is the Fed is saying, we want to make cash trash, go out and spend this. And so that was a little bit surprising to hear that. I wonder if it's Cisco specific or part of a broader trend.
Don Luskin, tech has been pretty hot. I just want to ask you on this. Does this wreck the bull market story at all? Does this dent that story?
I don't think so. I mean, a year ago, Chambers was wildly enthusiastic, and we've had a year of very tepid growth. So maybe now that he's getting tepid, we'll have a year of wild growth. I don't know. It's got to be Cisco specific. I don't see what he's seeing.
You're still playing it from the optimistic side. I read one of your reports. You're looking for a very big gain over the next 12 months, are you not?
I am. I think that it's really pretty easy to think that stocks could be about 25% to 30% higher than they are today. And I don't think that requires any particularly bizarre, heroic assumptions. We're only 10 or 12% below all-time high forward earnings. We'll get back up there just by the natural drift of upgrades that'll happen over the next year. If we can just get back to the same multiple that we had a couple years ago, which is also the same multiple that we just had last February and March, that's not such a big deal. Well, you put those two things together, stocks are 25, 27, 30% higher. Yeah. And nothing I said requires a booming economy or irrational exuberance. It's just going to happen.
Lee Munson, you may have a disagreement.
That requires some like voodoo math. I don't even understand where you're coming from. I mean, are you seriously talking about the U.S. markets, or did Tom at SatOps like confuse you with CNBC Asia? How are you going to tell me that we're going to go back to a multiple, which we had a couple years ago, which everybody know was a debt-driven market, when we have unemployment near 10%? QE2 is not going to help.
Sir, we had that same multiple. We also had that same multiple a year ago, so we can do it in this new environment. We just did it.
This new environment is based on some 1990s, concept that we're going to keep this high productivity. When, in the Wall Street Journal today, they're talking about getting rid of tax, interest on mortgages for 500 up. So you're going to kill the upper middle class on the coasts. And you really think that the corporations are going to be impressed with a 26%, corporate tax rate? I mean, nobody's going to leave, Intel's not going to leave Ireland, just because the corporate tax rate goes down a few percentage points.
Of course,
I think your whole idea that we're going to go back to
leaving
this,
Ireland, but we're going to get to that. I'm worried that Ireland is leaving Ireland, but I'm going to get to that later in the program. Barry Ritholtz, on this issue, I want you to weigh in with your market outlook. I was very impressed that for 2 of the last 3 weeks, jobless claims, initial unemployment claims, now down around 435,000. That breaks some new ground on the low end. It is not gangbusters, but it does suggest employment may be creeping up. We did see better jobs numbers for October. We've seen better ISM's numbers. We've seen better car sale numbers. Is the economy getting stronger just as the Fed will launch its QE2 bond purchases on Friday?
You can add to it slight increase in wages, slight increase in hours worked. Look, this is not by any means a blockbuster economy. We're getting a little better slowly, but it's marginal. This is a 1.5, maybe, if we're lucky, 2% GDP.
Not 3% in the fourth quarter with some of these new data points.
Maybe if imports drop off, more than and the weak dollar is helping us export more stuff. Maybe we're going to see a little of that, but
and a 30% profits rise.
Well, that is as Don, I'm going to say something I never said before. Don and I are in completely agreement of this. We've had what, Don, and you can verify this, 5, 6, 7 quarters of improving earnings. We're at $90, $92 on the S&P for next year. I think the peak was 103, 105. We're really not that far away. The problem that's overlaying this, right? We're not that far from it. The problem is the multiple contraction, and whereas we're fairly valued, I mean, we're not dirt cheap, we're not terribly expensive, but the PE ratio continues to contract. It makes it hard to get a good multiple.
Let me talk to that point, all right? Because back when forward earnings were at 103 in October 2007, the forward multiple was only 15. Today it's 13, and it was about 15 just a year ago in our sadder but wiser world. So it's just not out of the question to think that we can get back to 15. Nobody's saying that we have to get back to 22 or 25 like NASDAQ 5,000. 15 is not a crazy multiple. It should be pretty darn easy.
All right, hang on one second. Stay right where you are. Stay right where you are. Don't move an inch or a muscle. We've got a huge development out of Washington today, as everybody knows. President Obama's Deficit Commission, that's Erskine Bowles, he's released a draft of their upcoming report on how to curb our growing fiscal mess and the outlook for bankruptcy. There are some dramatic spending cuts. Taxes go up and down. Let's get Eamon Javers live from our nation's capital with all the details. Good evening, Eamon.
Good evening, Larry. Well, it didn't take long for the long knives to come out for this report today. The commission put this thing out a little bit unexpectedly. We weren't prepared to see this today. They didn't make any advance announcement of it, but they came out of this behind closed doors meeting, rolled out all the details, and within hours of that rollout this afternoon, groups on the left particularly and also on the right really rolled out attacks against this thing. MoveOn.org, for example, called for people to go out and get the president to block this thing. They do not like what they're seeing out of this report here. But the co-chair of this group, Erskine Bowles, who you just mentioned, came out today and said that the stakes here couldn't be any higher.
This debt is like a cancer that will truly destroy this country from within if we don't fix it. And we can't grow ourselves out of this problem. We could have double-digit growth for decades and not solve this problem. We can't tax our way out of this problem, and we can't cut our way out of this problem. It's going to take some combination thereof.
And Larry, the reaction inside the commission from this proposal, which came from the two co-chairs, was decidedly mixed.
This is a serious and impressive effort. It's a good start. They're taking this very seriously. I'm excited to see another plan be put out there. As a person who's authored a plan myself, I'm just pleased to see more ideas are coming to the table.
But I think if there were to be a vote of 14, it will look very different from the proposal that is made today by the chairman, and I can't imagine that they didn't understand that. This is not a package that I could support.
So, Larry, inside and outside the commission hearing room today, there was definite mixed reaction to this. Interestingly enough, the President of the United States today did not take a stand on this. His spokesman came out and said late this afternoon that the President's going to wait until December 1st when we get the final report before he offers any comment at all, Larry.
All right, Eamon Javers, thank you very much. Let's go back to our panel. Lee Munson, I want to ask you, what do you make of this commission? We have no idea if it'll pass. Probably it won't, but who the heck knows? Is this a game changer for stocks? Does this have any impact on your market thinking?
Yeah, it does, because what it does, it illuminates, I think, to the American public what kind of mess we're really in. I think that the important thing to note is that there's nothing that we really can do about the spending. We're going to try to reduce, $100 billion in defense spending. I think that's going to happen naturally. But I really think it shows that the big thing that nobody wants to talk about, and you'll notice this, nobody really wants to talk about currency. We had Japan in September make a major assault against our currency, and you didn't have one tweet out of the White House concerning this.
By the way, I tweeted. Lee, did you know I tweeted on that very point? I tweeted on that very point that they should have
from the White House. else from the government.
They should have had a king dollar component linked to a gold reference point in there to assure our stability. I actually tweeted on it, but please continue.
Well, I think the whole thing is that the American public is being sold a bill of goods. Now, listen, I think it's great that we're trying to cut spending here, but when they try to insult our intelligence about they're not going to allow earmarks, it really signals to me as a market participant that they're really not going to do anything about spending. So I think this was a non-starter. I think it was a smokescreen. It's not really going to help. Yes, I think we need to lower it. My market outlook is still based on this terrible problem that we have with the Asian currencies, the ability of this government to do nothing about it, and this 1990s delusion that these other two guests, even though I love Barry and I love your website and I love the blog, I really can't agree that we're just going to float with upgrades to a 15 multiple or even stay at a 13 multiple when we're out of that phase of the 80s, the 90s, the increased productivity. We have high employment twice as much as Japan.
We don't have a lot of time. Barry Ritholtz,
sure.
Let me ask you one other thing. You heard the challenge from Lee Munson, but the Fed does start buying bonds on Friday. Now, this is an odd story because the whole world seems to be against the Fed. That's point number one.
Absolutely.
But point number two, long-term interest rates are actually going up, not down, which is counter to what the Fed is supposed to do. Now, they're going to buy about $105 billion in total on Friday. That launches quantitative easing. How does that impact your market thinking?
I really don't care so much about PE multiple or where earnings are 6 months, a year from now. If you're going to give me $100 billion a month for the next 6, 8, 10 months, we're going to have a little bit of a stock market party. And to me, that's the driving force. Half the hedge fund managers out there have become armchair policy wonks. We're a nation now of amateur Fed observers, and people are overthinking this. It really doesn't matter how bad this is. And you and I have talked about this. Ultimately, we know this ends badly.
It will end badly.
But for
and you
now,
were a big critic of the Fed's ultra-easy money 6, 7, 8 years ago.
Exactly right. But right now, when we have this sort of environment, the Fed is going to basically say to corporations, your cash is garbage. To investors, your cash is garbage. Put it to work. We're making cash trash. So we just want to ride this and hopefully jump off before the train hits the wall.
Optimist. Don Luskin, I know you've fallen in love with the Fed. You're swooning with the Fed, even though the dollar depreciation potential is enormous and the future inflation potential is enormous and gold is enormous and commodities are enormous. But you see an enormous stock market rally, don't you?
I do. That's because the Fed's been too tight, and they've been stuck at the zero nominal interest rate bound, and they've found a new way to not be too tight anymore. So it's all good. We've all had plenty of experiences with central banks too tight who suddenly stop getting too tight. Make stocks go up. Don't worry about it. It's all good.
And what if the dollar continues to fall, Don? And what if the liquidity goes overseas? And what if we have some kind of quasi-currency or trade war? I mean, virtually the whole G20 is against us. What do they know that you might not know?
I know, look, what is this, the Kerry campaign? Do we have to subject our monetary policy to a global test? Look, our Fed's too tight. They're getting easier. Say thank you, Ben.
Thank you, Ben. Lee Munson, I'm going to give you the last word. You thanking Ben Bernanke, Lee?
No, I'm not. I don't think he's doing anything good, and I'd say beware the Ides of March because I think it could happen in December or January. I think everybody here is way too optimistic. Half the hedge fund managers, they're too bullish on the S&P. I'd be cautious. I'm not so happy. All
right. We're going to leave it there, gentlemen. We covered a lot of ground. Thank you ever so much. Don Luskin, Barry Ritholtz, and Lee Munson.